नमस्ते इन्वेस्टर्स। हमने रिसेंटली मिस्टर पुनीत खुराना को अपने इन्वेस्टिंग कारवा के सेशन में होस्ट करा था, जहाँ पे उन्होंने बात करी कि उनका इन्वेस्टिंग जर्नी कैसा रहा है। व्हाट इज हिज इन्वेस्टिंग फ्रेमवर्क वेर इन ही फोकसेस ऑन नंबर्स ओवर नैरेटिव्स। उनका क्या लाइब्रेरी ऑफ मिस्टेक्स रह चुका है, क्यों वैल्यूएशन उनके ओवरऑल फ्रेमवर्क में बहुत इंपॉर्टेंट पार्ट है, एंड और क्या उनकी अदर लर्निंग्स रह चुकी है इन मार्केट में सिंस लास्ट 2 डेकेड्स। वो सब और भी काफी सारी चीजें उन्होंने डिस्कस करी थी ये वेबिनार में। तो हम लोग उसका वेबिनार का रिकॉर्डिंग आप लोगों के लिए लाइव यूट्यूब में डाल दें। सो डू वॉच दैट वीडियो। थैंक यू।
A very good evening, everyone. I am Ankit Kanodia, founder of SmartSync Investment Advisory Services. Welcome to the 15th episode of Investing Karwa, an initiative for our Mission Smile community. For those who are joining in for the first time, Mission Smile stands for making new stock market investors learn it through engaging research. In Investing Karwa, we call investors who have seen multiple cycles to share their learnings, their struggles, and their mistakes so that we can all learn from them. Today's episode is titled Long Evidence and Short Narrative. Many of you would have already guessed it by now, but for the benefit of everyone, let me introduce Mr. Puneet Khuarana. It is like doing a podcast with the podcaster. So we all are aware that Puneet runs this wonderful podcast series called Stoic Podcast, along with his friends Manish Dhawan and Nuresh Virani. I've listened to almost all the podcasts which Puneet has done till now, and I would highly recommend all of you if you have not yet looked at it. Now, a brief intro about Puneet and his background. He is a CFA US charter holder. He is an MBA from MBI Gurgaon, BTech from NIT Bhopal, member of Mensa India over 1.5 decade, and over 1.5 decade of equity research and portfolio management experience. Former research head at $1 billion plus India focused hedge fund, keynote speaker at prominent investment and academic conferences, guests on CNBC, visiting faculty at IIT Delhi, and many more. So with all the intro out of the way, Puneet, I would first request you to start with an opening remark, and then we'll straight away dive into the Q&A.
No, thanks for having me. I don't know how much value I'll add to your listeners, but I'll try my best. Whatever I've learned, I'll try to give further. So yeah, good to go.
Thank you. So I'll just straight away go to the first question. Let's start from the start. Tell us about your early days, a little bit about how you started investing, serendipity or a dream profession always, any one significant incident that moved you towards it. I think that would be the right way to set the tone.
Yeah, you're taking the first question, which I ask my podcasters to start from the start, right? So, my to understand my start, I think it's important to understand that I don't come from a family of investing at all. So on the contrary, a very quick background. My mother was, belonged to a well-educated IITians, army personnel kind of a family. She got into education, well-educated, got interested into Hindi literature, and then eventually became a professor of that. My father, on the other hand, belonged to a very poor family. And being the middle son, he had to leave education to take care of the younger as well as the elder son's education. So having said that, he started from a clerical position to a key management personnel position. It was a very hard, and so I've seen that hard work which goes into the journey which he took. So I think it was the combination where my family understood the importance of education and the importance of hard work, and that's how both me and my sister were raised. And well, fortunately for my parents, we were okay with academics, so we did decently well. We used to score good marks, etc., etc. And eventually, I made my way to go to NIT Bhopal, and I mean, pretty much my path was set for me, right? It's like any middle class family. You do engineering, then you go and you take a good corporate jobs, or maybe do something else, and then go and take corporate jobs, and then go from there, win the corporate world. What transpired, on the other hand, was absolutely reverse, right? I went into a BTech school, and I think the genesis of my investing actually started there. I remember third year of my college was the first time we got individual rooms in engineering. So till that it was shared rooms, and third year we had individual rooms. And I belonged to a wing where there were a lot of Bengalis. Okay, so a large chunk of my friends were all Bengalis in engineering. And one of my friend, he used to read a lot of business magazines. And a very close friend, we used to talk a lot, and we used to play together, etc., etc. And I was curious because I have never had any understanding about business world per se. Belong to a absolute no business family, never thought about businesses, nothing like that. And it's a funny story. We remember that we used to read Business World magazine because वो 5 रुपए की आती थी और Business Today 10 रुपए की आती थी. तो हम लोगों ने सोचा कि Business World पढ़ेंगे, and he said that if you want to read with me, you have to do a contrary. So we used to do one week buy of magazines. That was my origination, so to speak. Of course, I mean, I obviously
did. Talking about which year?
This is 2003, I think.
Okay.
Somewhere around 2000, 2002, 2003, something like that. So, but yes, again, when I say genesis of the investing, I'm using the word investing very loosely, okay? Because what we did at that point, we just saw the seed of the idea, right? Okay, ये भी कुछ होता है. And of course, mess में जाते, so there were no TVs, right? So the TVs are only in the mess. So when we go to the mess, everybody wants to watch sports, and me and him, we used to wait for people to go back to room, and then we used to put CNBC and watch CNBC and all that kind of stuff. So from there, I think the interest lied. I probably never thought that this is going to be a career. Again, like any other engineering student, CAT was another ambition for most engineering students, and I gave CAT. I got through some IIMs and MDI and all these colleges, and I think this is where the genesis converted into at least a start of a career, if I can say that. Again, it was not really a career, but when 2007, I think, when I joined MDI, I heard about Professor Bakshi. I wanted to meet him. So I just, it actually didn't happen in the initial phases because, again, a serendipity thing, right? 2007, first day of my college, I injured my leg badly. We went to play football, and I think I was bedridden for close to 5-6 months or something like that. I was carried by my friends to classes. It was that bad an injury. And I got through an IIM, a couple of IIMs actually, through the wait list. And I just couldn't go because of my injury was so dramatic. Again, at that point, I thought, what the hell, yeah, I could have been an IIM student and so on and so forth. But in hindsight, that was probably the best thing that happened to my genesis to investing, because I said, okay, now I'm stuck to MDI, and Professor Bakshi was very popular. So after I started walking, I went to meet him in his office. And after a few courteous discussions, obviously he didn't want to check me out immediately, but after a few courteous exchanges, he said, "Ki ye lo Warren Buffett ke letters aur ye padh ke aao, tab baat karenge," right? Something like that. I mean, obviously in a funny way. But the idea was that he guided me towards that first step towards investing. And once you go there, I don't think there is any hook stronger than Buffett letters to keep you in that zone, even if you don't know anything. Like, again, remember my background. I'm an engineer. No understanding of accounts, no understanding of finance in general. Some some interest in business, but nothing more. So that is where I think my start happened. And from there, by the way, I used to read a lot about Warren Buffett, Charlie, and all that kind of stuff during my college days. My college education took a back seat, and this education took a front seat. And while reading, I also studied a lot about the Enron event, and the short sellers. So Jim Chanos, David Einhorn, and all these kind of people. And I was so fascinated by this part. and so there were two of these clashes in my mind, but I was just curious to know more and more. So I was actually interested in both of these areas. That's how my investing started. Of course, after that, again, serendipity. When we were entering the college, it was the peak. By the time we were in, shit hit the fan, and everything which could go wrong with this industry went wrong. So I possibly couldn't even, even have there was no opening. Forget about not getting anywhere. There was no opening in any of the funds, any of the buy sides. I don't know any of the listeners who are not part of that will be able to imagine the pain that period was. It was not like a COVID crash, ki aaya aur chala gaya, right? It was a long gestation pain, and a lot of funds were fighting for survival. So at that point, I thought, okay, maybe investing ho gaya khatam. And my parents were happy because unko lagta tha stock market is bad. And given their background, it's not surprising that people think that. So they were happy, but I persisted for close to a year and a half before, again, serendipity. I actively seeked a lot of jobs. I called crazy number of people. They also probably invited me because I was young and I was looking for things, but nothing transpired. Majority of the people were interested in derivatives. I was pretty sure I don't want to do derivatives, and so on and so forth. Again, naive thinking. It wasn't that I was sure about something out of wisdom. I was sure about something because of naivety. But again, that worked well for me. So hindsight is always 2020, right? So it worked beautifully for me. So yeah, so I mean, I did CFA, I did MBA, and there was no job in the markets. Okay, so 1.5, and serendipity works in the very, very funny way, right? I got my first hedge fund job by some friends, relatives, friend were talking, and they said that, we are looking fundamental centric guy, and this guy said, I know somebody, and we met, and they were looking for somebody for a year and a half. I was looking for a job for a year and a half, and it just clicked. I mean, when we talked, it was as if we were talking the same things, same understanding, same principles, same philosophy. And when that clicked, from there, my practical journey started, so to speak. And that's how I went into this, in the field of investing, if I can say that. I mean, of course, I was doing parallel investing from 2006 onwards, but I don't classify that period as an investing period, because that was more like a learning yourself without having any structured way of thinking about investing in general.
Thanks, Puneet. So it is your podcast, but I just want to share that when I was listening to you, I was reminded about my own story, because I also happened to do MBA during 2007 and 9. And I also went through that same period where there was no jobs. And at that point of time, I was thinking probably what is happening around me. But it was, in hindsight, when I look back, I think that was the best thing to happen. And of course, I don't want to go into details, but I can completely relate to you, both in terms of starting with the Buffett letters, because I also did the same thing. And probably I did it much later than you, but and also with the environment when what it was in that 2007 to 9 era. So I can really understand.
It was a crazy time, right? I mean, I don't remember. And after that, I don't think anybody has seen that kind of a pain in the financial market, which
Exactly.
is why. So I don't know whether it's good or bad, but when your start is that crazy, by nature you become conservative to some extent. But anyways, that's a different.
Yeah, so
I divert a lot to that.
No, this is very helpful and very relevant, because majority of our audience today, not just people who are present here live, but people who will probably watch this recording, they have not yet even imagined what kind of, they cannot even imagine what kind of event 2008-9 crisis was. Like Gaurav Sood, we had invited him last year. He narrated about his incident. That was again an incident which was completely, it's something which you can learn a lot from, how a crisis like that can really shake you out. You are talking about yourself, and it is very relevant, because people who have joined in the last 3, 4 years, 5 years, they have not gone through that pain at all, right? So I think it is a good way to start the discussion today.
Funny story is that so we were invested in the markets in very limited capacity as a student, whatever we could. But I was invested in the market in 2007 and 8, and funnily, we didn't lose any money. Okay, because we timed the market, so to speak, absolutely perfectly, because a lot of professors were guiding us. This craziness is happening in the market, and this kind of thing happens, that kind of thing happens. And somehow, I mean, we pulled the money. When I say we, I'm talking about myself. I pulled the money out, and when the market crashed, my portfolio didn't. Mostly cash kind of a thing, and I think myself as to whether I can replicate that today. It is so difficult to replicate that today because of how much you have known after the markets, and it was such a beginner's luck at that point in time. But anyways, yeah, it was a funny story.
Great. So moving on, Puneet. So you have done two excellent presentations, I think, on the CFA Society platform. One is the Library of Mistakes, and the other is Fooled by Backtests. While a majority of my my questions will be a follow-up on the points you made in those presentations, I'll start off by asking you what one dear investing philosophy or construct you had in mind when you started off, but later on gave it up as you evolved as an investor. Maybe you can give some examples if you like, but I think that would be a good starting point for us.
Yeah, just 1 second. Sorry. Yeah, so one philosophy. Well, there have been so many evolutions, difficult to pick one philosophy, but if I have to really pick one, would be difficult, but there are many constructs which have been challenged the more I have evolved in the field of investing, right? The first construct which you learn when you are studying Buffett letters is buy and hold. I don't want to use that term because he never actually implicitly used that term, but he talks about thinking like an owner and how owner will be attached to a company for a long period of time. You go through the thick and thin of the company and so on and so forth. I think that one philosophy has changed. It's not that I've become a trader. It's just that my way of thinking about buy and hold has changed dramatically. How I earlier used to think and now how I think now on buy and hold as a construct, or very long-term holding as a construct. Okay, so that is one thing which has changed. But I mean, remember Buffett words in your mind always when I say this, right? So he has that famous thing of 20 punch card thing, right? Never buy one investment, do one punch card, one hole in the punch card, and kind of stuff. So when that was your theory, and when you get into the practice, you see where it can probably help you and where it can probably fail you. And that is one thing which I've dramatically different now. It's also the kind of businesses. So another construct is quality. Okay, so quality is there. If it is quality, it will always bounce back. And there are many people keep on harping about that point. I'll come to the evidence working later, but we have spent a lot of time on this particular testing. And I have a much more nuanced understanding about when to buy quality and when not to buy quality. Now, obviously quality stocks are better, but thinking that, okay, quality is, so these are some constructs. There are other constructs also, like cyclicals mein paisa nahi banta hai. You don't get into industries where the cycles are very choppy. We have a completely different experience there also, and eventually had created enormous returns from those kind of ideas. And another, I'm just thinking, while you have asked the question, things keep on coming. Another thing which I probably have changed dramatically is I've stopped thinking 10 years down the line. Okay, everybody says, "Ye company aapke portfolio mein, how do you see this company evolving in next 5-10 years?" I don't think this answer is. I don't think I have that answer. I don't think the promoter have that answer. Interestingly, in Mumbai, Nitin bhai is here. We were meeting a promoter, and he said, "Yaar, मेरे को नहीं पता कि 6 महीने बाद मेरे business में क्या होने वाला है, but मेरे street के analyst को सबको पता है, right?" So, and that is one construct which has changed over a period of time. We do think long term, but the long term is constituted of short terms. Okay, so you need to evaluate. I don't remember where I read this, but somewhere I read that 10 years stock holding is actually holding 1 year stock journey for 10 times. Okay, it's like that. So, and my larger holdings, when I go back and I check the bigger winners where I don't want to use the term multi-baggers because that will come bite me. But the larger winners of my portfolios were not technically buy and hold. They were constantly being evaluated for a long period of time. It's just that we never got an opportunity to sell, so we never sold. Okay, so that is one another construct which came to my mind when you asked that question. There is a actually, I mean, I don't know how much time we have, so I can probably add a few things here.
We have all the time. So the rule of my podcast is very simple. As long as audience is there, as long as the guest is there, I don't have any.
Yeah, that's a good rule to have. Yeah, good rule to have. So, while you were asking about how things have changed of the construct I used to hold dear and not hold dear, a lot of it also happens by the journey you follow. Okay, so it's not that all of a sudden something clicks. It's also how your journey has been. So when I started my fund working, my fund was very fundamental centric. So the way the fund was structured was there was a macro team coming up with macro themes, which is basically the fund manager. And then me and another team member of mine who was my first boss also, we used to collectively work on the fundamental side of things. And completely, I mean, think about everything you have read about investing. I was doing management meetings, I was doing channel checks, I was doing data was, I mean, when I joined the fund, there was not much of the data work happening at a fund level. It used to come more from the sell side, but eventually we did everything in-house. So, models, and I mean, I know people say Excel investing is poor investing. I don't agree with that. On the contrary, it's a fantastic way to get really good insights. But anyways, I'll come to that later. And everything when I was doing that, I was becoming a research guy, right? I used to think like a researcher. And when you think like a researcher, you want to go deep down. You want to keep on going, keep on finding the next thing. You want to reach the end where you have nothing more to do. Okay, that's how you are trained when you are doing stock analysis. When I went into portfolio management, that was a different ballgame altogether. Okay, so when I left the fund, I started doing portfolio management. That was a different ballgame altogether. There, you have to draw the line between where the research stops for all practical purposes and where the research, is just you're doing the research for the sake of doing the research. Okay, and many times you do that. I mean, there's no right or wrong there. Sometimes you do because it gives you a comfort of knowing that मैंने ये किया है. Okay, कई बार उससे कोई value add हो रहा नहीं हो रहा. That's a separate point of discussion. So another thing which I challenged myself when I went into portfolio management was that I need to honestly answer myself whether this particular activity is adding any decision-making value to my working or not. If the answer to that question is no, just chuck it out, just throw it away. Okay, so cut 10, 12 years from that time. Today, I don't really meet managements. That activity doesn't add any value to my decision making. So I don't meet managements. I do channel checks, but for a very different perspective. Channel checks are more to challenge a particular hypothesis, which is very strong, if at all. Otherwise, I don't really do a lot of finding insights from the ground, which is again something I'm sure people can do. I'm not saying that it's a waste of an activity. It's just that I had to ask myself that whether that thing is adding to my process, my decision making in any way or not. And the more the answer is no, the more you cut it down. So another wild held belief which I let go was that, again, something which I find very funny when people say that you need to know the company better than the promoter does if you want to own that company. I find it so funny when I hear this, but that's how it is, right? So actually, probably they want to say something else, but when they make the statement, first, that's never going to happen. Second, what you can see is a different perspective. Promoters are usually on the ground doing their work. They generally are not looking things from a larger capital allocation perspective to a large extent. I'm not saying everybody, but to a large extent. That is where your investor hat is actually different from the promoter's hat. So you don't need to understand businesses deep down at an operational level at every damn nuts and bolts, but you need to have the larger picture in mind, which sometimes promoters, because they're too close to the ground on a daily operational level, they might not have. Some promoters are really smart, so there's no general painting here. and that is another belief that was challenged when I was. So again, you might be wondering how many beliefs are challenged during the journey, but that's the whole idea. I mean, investing is beautiful in a way that it keeps on challenging you on possibly everything which you think which is also the genesis of a lot of ideas or back tests or everything which we do now as a part of the firm.
So thank you, Puneet. So I have a lot of follow-up to this answer.
Yeah, sure.
So number one follow-up is when you say that you don't want to look, say, 5 year, 10 year down the line, you'll probably assess every 2 years, 3 years, or at any point of time, you will probably see where do you see the company 2 years down the line, 3 years down the line. And it will be a rolling 2 year, 3 year exercise, right?
Yeah, actually, I don't even do that.
Okay.
Let me go further back. I don't try to forecast anything now. Okay, that might sound very, very surprising, but I am not looking to forecast. I am looking to get my knowledge to a level where I can say whether things will be dramatically different from the past or not. Okay. And if there are no valid reasons, past is a good guide. People say past is not a guide to future performance, sure. But for companies, if somebody has demonstrated something for 20 years and you think something will challenge, unless there are very, very strong reasons to believe that the dynamics of the industries are changing, I would tend to go back and think in future a lot. I don't do that exercise to build 10 year down the line or 5 year down the line ki business kaisa hoega, because there is just way too much movement in the way businesses are evolving nowadays. Some, of course, are pretty steady, and you can pretty much see. And when I say I'm not forecasting, it's not that it's not that it can't be done, but what's the ultimate purpose of doing forecast? I mean, let me ask you: when people say let's forecast, why are they forecasting at all? What's the ultimate intent of forecast? It is to, for some people, it's a valuation exercise. क्या मेरे को 20 साल का नंबर डालना है DCF में, तो कितना growth rate डाल सकता हूँ, और and उसके लिए भी, if you ask very honestly, majority of them will still take past as a guide कि अच्छा 15% चल रहा है, conservative ले लेते हैं, 12% कर देते हैं, and so on and so forth. There's a lot of using history as the guide anyways, unless something dramatically is different. Except for that part, why do we do forecasting of businesses? I fail to understand, and it's not a part of my philosophy now. Sure, I used to think that. So another belief that got challenged. So the more we converse, that question will keep on coming. So earlier I used to think, yeah, I need to know it so good that I can tell you how this industry is going to evolve 10 years from now. After 10 years, but probably whatever I thought in that 10 years back, probably nothing of that would be there, except for few industries which are by nature are not, very, they're not by the nature very volatile, right? Nestle mein business mein kitna challenge aa jayega, you can't really, it's very easy to comment on those companies. Right. Similarly, no point naming, but yeah. So that's how it is. Go ahead.
So I was about to ask you about DCF and you have already answered that. So great. So my next question is, one of my mentors, I will not name him right now because he might not like it to be named. He mentioned that, you mentioned this point, long term is a summation of a lot of short terms, right?
Yeah.
He mentioned a completely opposite thesis, that he says that no, unless so when I say, so for example, if I say, I like this company, I like this management, I like the valuation right now, and I'll buy now, and I'll keep evaluating every year and see how things are going. If things are going well for the next 10 years, I'll keep on holding. If things go wrong anytime in the next 10 years, 1 year down the line, 2 years down the line. So then he says, my mentor immediately says that is not a long-term investing. That is basically a summation of short-term investing. So when you think you are a long-term investor,
yeah.
So I'm not claiming I am a long-term investor because I do the same thing. I evaluate every year, right? Whether it is.
So I'm pretty sure that your mentor, when he's talking about long-term, maybe the unsaid part is that if you try to see how things are going, things are never going to go smoothly. Okay, things are always going to go topsy-turvy to some extent. Okay. Right. So what he's probably, again, I'm speculating here. I don't know who he is, but the important part there to understand is the behavior on that topsy-turviness journey is where the behavior of long-term and short-term gets defined. Okay, but you need to keep a close watch. Doesn't mean that you need to act, act on the same frequency at which you are looking at the businesses. Obviously, the great businesses or good businesses or whatever you want to call them, by default are structurally so strong that you know for a fact that they are going to be there, that journey which you are seeing. Okay, and in that sense, it's a good framework to have, because that also increases your comfort in holding the companies through tipsy and turvy points. Okay, when I'm saying that I don't do that, what I'm trying to tell you is that I am not, when I'm sitting here, obviously, think of, okay, let's give an example, right? So let's say today I'm evaluating, okay, very dangerous to do name of the companies, but let's say क्या example they are?
I should
Again,
know
let's,
this.
yeah,
Simple
let's take
large
Nestle
cap
as a
companies
very
का नाम
common
लो.
example. सब लोग Nestle बोलते हैं, Asian Paints बोलते हैं, सब उसके examples देते हैं, right? Do you see Nestle going anywhere in next 10 years? Of course not, right? Do you see a smaller steel manufacturer going somewhere in 10 years? Probably not, but you probably know that the journey is going to be very tipsy-turvy. Okay, so when you are evaluating those businesses, obviously you will be more comfortable with the business that gives you that kind of a visibility. But you're not trying to project that. You are just saying that, okay, my behavior is going to stay in check. That is probably why that statement can make a lot of sense. What I'm trying to say is my holding in itself is an evaluation at a period of time. Some companies, of course, if a quarter is bad or a couple of quarters are bad, and I know that businesses are not, changing a lot, I'm not going to react to that, but I'm still going to evaluate it on the consistent basis. And that also becomes a very important genesis when you're working with data, but I'll come to that later.
Great. So I'll now move on to the next set of questions rather. So you shared a very good tweet by your trader friend Ashish Gupta about back testing.
Yeah.
Let's start from there, and I think I should share the screen and show the tweet to everyone.
Yeah, it was a funny tweet.
I hope it is visible, right? Let me just make it full screen. Yeah. I hope everyone can see this screen, right? So I'll now get back to the question. So let's start from there and pick your brains on what is backtest, how an investor should look at backtest, what are its merits, and most importantly, what are the demerits of backtest?
Well, that's going to be a long answer, right? So it's like the entire CFA presentation was actually on that. And I'll be honest with you, this tweet was actually sort of a genesis also in my mind. Why is it that people, when they are backtesting strategies, they look like this, and when they actually implement those strategies, they look like that? Because my experience has been quite reverse. Not reverse basically, but my experience is that there is not too much gap between the actionability that comes from the backtests which we do, and eventually when we make it a part of our workings. Okay, and that was the genesis of the thought, and that eventually led to a presentation somewhere around 2.5 to 3 hours. I don't know, but that was the genesis, how it started. And I funnily I call these black tests. They're not really back tests; they're black tests, because most of the time people doing the back tests are also not able to understand all the moving parts that are going into the output of the back test. Okay, so they're like black boxes converted into back test. Another problem which I often find was that this word was starting to get overused, in the sense that we have backtested this and it has given that. We did this study. So eventually backtest was becoming more like a marketing material rather than a truth finding engine, which we call it. Like, it's like you have to find truth from a particular activity. It was used not for this, but for this. It was used more for selling ki something ki, okay, yaar, humne backtest kiya, dekho kitna acha return hai, and so on and so forth. On the contrary, we've been doing backtest for long now. Not a single communication from our side has probably said ki, we backtested something and maza aa gaya, right? So And we don't do that for a reason. First, we're not trying to sell any product based on a backtest. For that is not the purpose of backtest in our mind. And I'll come to that why that is the case. And secondly, I believe that backtest or any such backward-looking exercise is an attempt not to find things, but to test and disprove, if I may say that word. Okay, it's to find what is crappier rather than what is something amazing. Because in amazing, there are a lot of things that can go wrong, and I'll come to that when I discuss about the merit and demerit kind of a thing. But that's how we think about backtest. So the way we think about it, it's a structural way or a well-formulated way to convert a market folklore into a usable investing principle. It might sound like a thoda heavy words, but that's how it is. We just take a lot of market folklores, we formulate hypotheses around it, and we test them to see if that can be used as a investing principle in general. We're not really looking for some mind-blowing strategies to come out of backtest. We do test a lot of backtest strategies, but the purpose is very different. Okay, so that's what backtest is for me. Merits and demerits. Now that's a very long conversation. Okay, I probably should open my PPT, okay. So first merit obviously is that it helps you. It keeps you grounded in the sense that you are able to say with precision what doesn't work. Okay, again, I'm repeating that same point. What doesn't work, you are able to see. Because you hear so many theses, and when I'm talking about these things, I'm talking at all the levels. I'm talking at strategy portfolio level. I'm talking at industry level. I'm talking at company level. At every place, somebody comes and say कि यार steel companies को ऐसे खरीदना चाहिए. ठीक है, वो कुछ भी हो सकता है. Reasoning could be spreads. Reasoning could be valuation. There's a very common folklore ki buy cyclicals below 0.5 price to book and sell above 1 price to book. I mean, 1,000 mouths, 1,000 advices, right? It's that kind of a stuff investing is. So when you're looking at backtest, you are basically asking, यार इतना सब जो ज्ञान है, इसमें is there anything worthy of converting into an actual actionable insight? Okay, and that's how we approach this. So that's how I approach, and this helps me not fall for a same mistake over and over and over again. This helps me. Actually, we maintain a list, right? So there's a huge list of things we don't want to do, no matter where it is coming from. And why that list is there, it's not because of my personal belief system or my experiences. It is something which we have rigorously tested, and we know that it doesn't work. We keep on hearing this again and again and again, but it doesn't work. That's it. Take it away. Okay, so that list becoming stronger and stronger. And I remember, I think it was Charles D. Ellis, right, who says that investing is more like a loser's game in tennis, right, where the focus should be not doing mistakes rather than trying to come up with a lot of winners. This is a beautiful framework that allows me to reduce my mistakes. Okay, and that is why backtest. So this is the merit, right? So another very interesting point about backtesting is that an idea or a principle can still be worthy of looking at. So let's say you and me are talking and you say, यार कि quality investing बहुत अच्छी चीज होती है, and we should do quality investing. Okay, and there is nobody who in his right mind can confront that at a principle level. Of course, holding great companies is a good thing to do, and eventually these companies will do good and all that kind of stuff, right? When you convert a statement like this into a testable hypothesis, you are able to find the fringe cases. You are able to find the outliers, and then you ask questions कि यार ये outlier क्यों है, या ये fringe case क्यों है, यहाँ पे क्यों नहीं बना, अगर ये thesis में इतना ही है, तो why is this not? And then you go to the nuances, because understand one thing, चाहे जो मर्जी होए, 30 years experience people, 20 years experience, it doesn't matter. Whoever is giving you any wisdom, it's a very refined wisdom. It's not a nuanced wisdom, right? It comes you in form of a final snapshot of a headline, जिसके पीछे बहुत सारे network effects होंगे जो आपको पता ही नहीं होंगे कि वो कैसे उस line पे पहुंचे. It's his experience, right? By doing this exercise of going back and asking this question, we're able to understand the nuances where something is actually a principle, something is not. And why are we doing this? Eventually we ask this question, क्या हम ये सब कर क्यों रहे हैं? अगर मैं कोई researcher तो हूँ नहीं, I'm not an academician who is writing papers on this, right? My ultimate purpose is to improve my portfolio performance. तो अगर portfolio में इसको मैं कहीं पे incorporate भी कर सकता हूँ कि नहीं कर सकता हूँ, right? You have to ask that question very harshly to yourself, that if I'm doing this, eventually my final output is that somewhere down the line it should contribute to my portfolio. Okay, so that's how that's the merits of this. Demerits are just way too many. Okay, the first and the biggest demerit is that just because you work with facts and data doesn't make it correct. Okay, on the contrary, this is you can actually fool yourself into believing wrong data, which is a very dangerous thing. Much more dangerous than narratives is to work with bad working on data and facts. Okay, that is one thing. The second is, I think that sometimes when you're working with data, it's an inherent human tendency to ask questions which you already want answers for. Ask the question in a way you want answers for. Okay, so you tend to ask the questions which you probably already know the answers for, and they will strengthen that belief of yours. Okay, the attempt is not made in a way to find कि ये कहाँ पे गलत होएगा. Okay, so if you're not doing this exercise intelligently, it is only going to further strengthen your disbeliefs, if I may call that word. Okay, disbeliefs. So I mean, again, there are countless examples, right? You can talk about company cycles, business cycles. Even I think couple of years back, I gave a presentation saying कि mutual fund सही है का जो campaign होता है, right? Everybody says 20 years return on mutual fund is this. Bifurcate that, right? First of all, how many of you actually invest for 20 years? Okay, if you do invest for 20 years, have you ever thought about what can happen in the intermediary years? Will that impact your decision making or not? Let's say there goes 5 years of not making money in equity markets. Are you going to be sane and say, okay, it's a part and parcel of the market or not? And you understand all the nuances when you do go back and test every kind of thing that has happened. In some cases, you have to go beyond India, because India is a limited history. India is just 20, 25 years of good market history. But the global markets also have a lot of lessons that can be learned. And we are blessed in a way that we are a slightly lagging market. And I don't mean it as an offense. I mean it in terms of progress where we are. Some of the developed markets have gone through that progress. So we have a roadmap. Of course, that doesn't mean that we copy that roadmap, but it gives us a large amount of things that can happen in parallel world. So the demerits are just way too many to count. I think if you really want my demerits, my entire backtest presentation on CFA was how backtest can be wrong. That was the entire presentation.
Thank you so much, Puneet.
Pretty long answer to a very small question, right?
No. That's perfectly fine, and that is what I wanted, and that's why the reason for asking that question was because I don't know how many of the people present here would have watched that presentation, but I'm sure after listening to your answer now, they will now go back and watch that presentation of CFA Society.
Unfortunately, it's not a very good recording, so voice is pretty low, but yeah.
No, but I watched that. Even if the voice is not low, voice is a bit low, but you can very well understand what you are saying. Right. Great. So moving on, I'll go to the next question. So the next question is simple. Now tell us a little bit about your Stoic evidence lab and how you and your team separate the evidence from the noise. It would be great if you could. So you have shied away from sharing any examples. So you may not take any current example, but you can probably share some past examples, because examples help us understand these nuances much better.
Okay. Interestingly, very recently, I did a tweet series on how people, when they say कि percentage of companies in their positive trend has a direct correlation with the market cycle, and we worked on this, and eventually that exercise didn't stop there. That exercise went on to a large extent to actually try to get some insight from that data. But part of it was shared on Twitter thread to demonstrate that how this can help you formulate that. Now, why we don't share a lot of it is because some greediness is there, in the sense that something is working, I don't want to share it. Okay, apologies, but that's how I think, right? A lot of this thing is going into portfolios for strategy purpose. Okay, so but we do share a lot of things which doesn't work, or at a principle level we have been able to verify. Okay, so we've done a lot of work on valuation, multi-baggers. I think the last Goa presentation where we met last time was entirely a summation of a very large, very large exercise which we did to find the traits of multi-baggers and how they differ across the cycles, right? So that so those kind of things we do share whenever I get an opportunity. I don't talk much in any public forums. I don't do a lot of investing meetings now. That also changed. Another thing, another construct that got challenged. So I'll keep on coming back to that question. In 2014 or 15 or something like that, 15 or 16, something like that. I don't remember the year. I went from a very actively discussing person to a completely non-discussing person, because another question I asked myself is whether it is helping my decisions. And I just thought that all this discussion actually hampers my decision making to some extent. And I stopped doing a lot of presentations outside. But anyways, so I'll come to that. But in case, if you can, just open that PPT. I think there's a diagrammatic thing which I have given in the Goa presentation, which might be helpful. If you
presentation, I don't
can.
have.
Or the any, I think you have the library of mistakes presentation.
Yeah,
no, sorry, the backtest presentation you have, right?
Yeah, backtest presentation.
The fooled by backtest. Yeah, I think it's there also.
Okay, let me just go there. What do you want to present in that?
There you will find sort of a funnel kind of a thing.
Yeah. That I know. I'll show. I got it. Let me just share. Yeah. Is this the one, Puneet, you are talking about?
Yeah, correct. So this is how the evidence lab ka structure is. Okay, so this is how we think about everything. Now, if you see on the left side, so we have funny names. I love. As I told you, my mother is a Hindi literature teacher, right? So from starting, I have read a lot of Hindu mythology and all. So from Gita, I borrowed two words. This is my Gyan Bhumi and this is my Karm Bhumi, right? So, but what you see on the left side is my Gyan Bhumi. It's like where I accumulate all the Gyan. Okay. Now, how do we do this? We hear a lot of things, right? We hear market wisdoms, we hear strategy Gyan. Sometimes we are talking to some smart investor and unko kuch personal epiphanies aati hai jo they share with us, right? And then there's a lot of market folklore. I do podcasts, so I talk to a lot of investors. I have read a lot. 2009 was I think 7 to 9 was a journey period for me where I just went on a reading spree of all thing investing. So I learned a lot from there. Everything which eventually comes in form of a gyan, okay, has to actually pass through this funnel. Okay, and to pass through this funnel, this is how we approach this. The first question we ask is whether it is worthy of a hypothesis. So if you can go to the next slide, I think I've kept some points which I generally ask. Not this one. Is there another one? Yeah. Okay. So this is perfect breakdown, right? So the first thing we ask is, ye jo hum kar rahe hain, whether it is really worthy of any hypothesis testing or not, because how much can you do? There's just way too much, right? So you have to screen things. First screening happens at a level where do you understand anything about it or not, right? If you don't understand anything about it, what's the point, right? Second thing is we obviously look at the source of this information or the gyan. So if the source is illuminary, you obviously give weightage to that. So if Buffett is saying something, I'm not going to say कि यार ये तो ठीक है, Buffett बोल गया. ऐसा नहीं होता, right? So when you're listening to Buffett or when you're listening to, let's say, a very senior investor in our industry, you take that gyan and you say, okay, the source is that good that I don't want to let this nugget go and I want to learn more about this nugget. Okay, so that's how I approach this. So the first question we ask is worthy of any hypothesis based on the source of the information. The next thing is the empirical work. So if somebody has already done some empirical work on it, that becomes a great advantage to me, right? So I'm a big reader of academic papers. It might sound very surprising, but academic papers are actually very insightful to a large extent, because a lot of things they do on the investing front, which, I mean, if you guys are interested, you should read some academic papers. They're actually pretty good in some ways. Again, we usually don't get a lot of insights because they're not practically implementable, but we get the base level testing Okay, somebody has done some empirical work, and we take that base work to see whether there is anything worthy of testing further. Okay, and then there is another question to ask: is ये जो ज्ञान मिल रहा है ये global, whether it works in global kind of a scenarios or it's an India specific thing. Okay, and that also becomes, because again, I'm not a global investor. I don't invest in outside countries. I invest in India. Okay, so a lot of things have to work around India. We learn a lot from global markets, but we have to see its implementation at an India level. So these are the way we define कि किस पे focus करना है, right? And then we go to formulate a hypothesis. So there is a hypothesis formulation that happens. Maybe an example, any example we can take. Let's say you have, let's say, when it's very simple thing, right? Let's say you say quality companies make money. It's the most commonly sold narrative out there, right? So, okay, if I ask you, and by the way, this is not a very difficult exercise to do. It's a more, if you think and sit and just ask honest questions, the hypothesis formulation is a very, it's a very learning of yourself kind of a thing. But if you ask questions, okay, you formulate a hypothesis for this particular thing, what will be the first step? Your first step will be, okay, let me first define quality. Okay, then you will say, okay, what do you mean it works? What are we talking about? It works over what period? It works meaning what kind of return? Does 10% mean it works, or does 25% mean it works? Okay, does 25% of a 5-year cycle is what I'm looking for, or I'm looking at an XIRR movements, at a short term also. So you have to define things, and this is a very enlightening exercise in itself, because it is not just the purpose of testing. It's also, it also tests you whether you really understand something or not. Okay, so that becomes now quality. When we start with quality, the quality definition, very, very easy definition, which most people say, right? High ROE, high ROC, low debt to equity, great cash conversion, and few more parameters, right? But when you think about quality, you can further drill down to the drivers, to the volatility of the drivers, and so on and so forth. So there is a lot you can define. Capital allocations. We have a quantitative capital allocation model which tells us the historical capital allocation, and so on and so forth. And that activity is where we also, I've written something which is, I never want to use that word now, because underlying first principle, you can see that, right? It's such an overused word nowadays. First principle, from the time Elon Musk has said this, I think everybody now knows the word first principle. And in investing, one thing which is like moat, right? Everybody now talks about moat and competitive advantage. So, but the key point here is, when you formulate a hypothesis, you keep the first principles in mind. Okay, you don't just create something out of thin air which has no economic observation to back it up. Okay, so it should make there should be an economic observation to first even have that hypothesis in place. Okay, and then I said robustness. This is where it's an iterative process. So when I told you about quality, right, I give you an example कि quality को define करेंगे. When you go back, let's say you define quality in XYZ way, the parameters which I told you, ki high ROE, high ROC, and you went back and you did some backtest. And let's imagine that the backtest says ki yaar, nothing great, 15% return, something like that. I'm not saying 15% is great or not, to each his own, but something like that. If that comes out, what is it that you're going to say? Are you going to directly come to the conclusion that, okay, quality doesn't work? Of course not, because what you're testing is what you have formulated. What if what you have formulated is wrong? Okay, so you think hard on each and every assumption which have gone into making that formulation. And if things do click, even then you go back and check. Ki, ye theek hai, dikha raha hai, but is my formulation strong enough or not? And this is different from curve fitting. You're not trying to fit the data output into something. You're trying to go back and check whether that particular thing has robust underlying principles, which is first principle I talked about. This is the most illuminating exercise of the evidence lab, if I can say so. Baki, everything else is a grudge work. So there are illuminating part. This is the illuminating part. Then there's a lot of grudge work. Then the final output is the illuminating part, right? So these two are the most interesting part of the whole thing. Obviously, after you create hypothesis, you use a lot of engines to find the answers. So I've written some of the engines we use: the time series analysis, correlations, backtest, visualization, and then we create a framework as to how you're going to use this. Okay, so as I told you, if you go back to the previous slide, No, not previous one, the previous to previous one. Yeah, this part, right? So eventually that thing, the testing which we have done, we convert it into a framework and we take it to a portfolio framework testing. कि ये जो हमने बनाया है, इसको हम कभी use भी कर सकते हैं कि नहीं? Okay, so for example, if I say cheap valuation makes money, okay, and the only time you got cheap valuations are 2009 and 2000, maybe early late 2000s. Is that insight of any use to you? Of course not, right? You will not be able to put it into a portfolio construct. सबको पता है 2009 में सब कुछ सस्ता था, right? But that's not the entire journey. COVID crash में every backtest, no matter whether you are a momentum guy or a value guy or a factor guy or whatever, you would have gotten into the markets one way or another. Momentum would have entered after the initial jump came. Value would have entered probably slightly before the fall or maybe before the fall, something like that, right? So extreme events are easy. And they obviously reflect good in the backtest, but how much utility do they have in the portfolio framework? And that becomes a very critical question. Half of the things which works as a standalone ideas, they fail to add any additional value at the portfolio level. That is where this part is the most critical part. It might not be the most enjoyable part, but it's the most critical part. All right. And from those frameworks, you can go back to that slide. So even if we have come to certain, belief systems from this, we constantly, so we have kept a frequency that at this frequency, we will go back and test this particular thing again. Why? Because it's easy to fall for, markets are evolving, right? So something that worked in 2007 probably will not work today. Okay, so you need to constantly check whether all the things which were reflecting to that particular theme or particular idea or particular strategy, are all those points, is the market similar? And the answer to that sometimes is dazzling. You see the underlying core assumptions which you made, they get challenged. Okay, because market regimes are changing, structures are changing. What worked in a high interest rate regime will not work in the low interest rate regime, and so on and so forth, right? So this is the Gyan Bhumi, right? After the Gyan Bhumi is done, after you have tested for the portfolio, then it goes and become the part of your decision making, and which is the second funnel. So if you go back, I'll just quickly tell you. I didn't anticipate this long an answer, but unfortunately that's how it is, right? So if you look at this, right, this is where the actual implementation happens. We convert that strategy or an idea into an implementable workflow. Okay, our main workflow. कि यार ये portfolio में जाना है, किस time पे जाना है, कैसे जाना है. And one thing, and no matter what presentation I say, if one thing which I say to people is that the first part of the funnel which you see is perhaps the most important thing you can do in your career. Okay, I didn't do it enough. If I go back, I probably would do it much more rigorously, which is whatever decisions you're making, okay, make a note of it. They might not be data-centric decisions. You might have a hunch, even if no matter what your decision parameters are, just make notes of those, because there is nothing more humbling than going back and reading your own analysis or your own reasons of taking a decision after that decision has either worked or not worked. Trust me, there is no better teacher than that. Okay. My large constructs of my mind have changed after I did this exercise. So my view on valuation has changed dramatically on that. I'll come to that later maybe, but this is a very important exercise. So as a rule, every decision which you're making, whether it is related to a strategy, going part of it, we take a transaction decision whether to buy or sell or whatever, is now getting recorded with a reason. And the reasons are bucketed. This reason is particular point. So for example, let's say there are 10 parameters to a particular thing. Valuation ek hai, corporate governance ek hai, forensic ek hai, etc. For everything, my findings and my reasons of taking the decision is already noted down. So if I go wrong, by the way, interesting outcomes also come when you go right. Okay, why? Because even if price has given you your whatever returns you are targeting, when you go back and check your reasoning for those, sometimes it is extremely funny that none of those reasons transpire. And still the stock has given you the return, which also is a very humbling and a teaching experience that, sometimes you make money not because your decision making was great, Sometimes you make money because it was somewhere meant to be, so to speak. And sometimes you lose money, but your decision making was so strong because everything you turned actually transpired. And this is the only way I know where you can actually do it. Where backtest helps is to add to this when you are not present. That's how I think about backtest, right? कि इसको इतना strongly करो कि अगर मैं नहीं था, मैं 2000 के market में नहीं था, that doesn't mean that I can't learn from 2000 का experience, right? So formulate it so well that you can actually learn from the insights. So it is like putting yourself in that era. And if you are not putting yourself in that era exactly how it was, you're probably not going to come out of with great insights. So that is, again, coming back to hypothesis formulation. That's the most important part, most interesting part. We actually think here. So okay, I might sound very silly when I say this. We go back and we check the newspapers for that time period when you actually, so we have this thing where we have is time pe ye emotions the, ye market scenarios the, and so on and so forth, because you have to be there to understand what is actually triggerable action and what is just a theoretical action, which you probably your backtest is saying. But reality mein jab wo aayega, so you probably will not press the button. Okay, so yeah, I mean, so this is it. So yeah, so this is the evidence lab. I'm sorry to blab around with for so long, but it is a very lengthy construct to discuss.
No, Puneet, I really enjoyed it. And as I said, there is no fixed time band which we are working with. So you are free to speak as long as you are okay with speaking about it. So I really enjoyed the way you described everything in detail. And I'm sure people who are listening to us have also enjoyed the discussion so far. So Puneet, I'll just digress a little bit. Right now, what we have discussed is we have discussed few concepts in abstract form. I would now want you to let us know how you actually do research and investments, starting from the point when you hear about a business from someone or read about it somewhere, to the eventual point of either discarding it or buying it in your portfolio. Again, I would encourage you to be as detailed as possible, because your whole process will be very useful for all of us, whether we accept it, whether we follow it or not.
Sure. So see, idea origination is, the more you are in the market for a longer period of time, you anyways have a large repository of companies you have studied and you have been following for some time. Okay, so idea generation, actually when I started long back, I used to start with screens as a way to generate ideas. I still do, by the way. There are still screens that give me ideas. But a lot of ideas also come from already knowing about a business, and so I go through certain parameters on a very regular basis for all the companies. Okay, small, big, large, doesn't matter. All the companies, industry-wise. So we look at the profitability numbers, the valuation numbers, and the growth numbers, etc., on a regular basis across all industries, all companies. Okay, so that is, since we do that on a regular basis for a long period of time, you get a sense of where we are in that particular industry cycle. Okay, generally I prefer companies where the industry itself is in. So no matter where you are, whether you're a momentum guy or a value guy, in both the cases actually it works. Industry where things are started to move in favor, the chances that if you pick something from there is much higher than an isolated winner. Okay. Similarly, in value investing, the chances that when you pick industries when they are in the doldrums and things are started to looking better, the chances of you going right is much better because the industry tailwinds take everybody along. Okay, so you are more the odds of your actual finding a winner, so to speak, increases when the industry. And this is something we also backtested with the multi-bagger presentation which we gave. So I think one of the findings was that also. But anyway, I'll come to that later. So there are some screens, of course. The difference between the screening, the way we do and the way I've seen people doing is that we don't have a top-down screen. Okay, we don't have ROE 20% se upar de do, leverage 1% se niche de do, because first of all, it doesn't help. Every industry is very different, and every industry's valuation and fundamental dynamics are very different. And thirdly, when you do absolute screens, okay, you are missing out on a lot of things. For example, you do a ROE screen, right? Go to screener, make a screen, say 25% ROE, 25% 5-year average ROE, 25% 5-year ROCR, whatever what you want to call it, less leverage, etc. You will get a good set of companies, sure. Okay, but does that make anything investable? Of course not. You need valuation, right? So then you will put a valuation ka number. In that you will do some valuation ka number. Okay, say अच्छा इसको descending order में ascending order में डाल दो, जो सबसे ऊपर आएगी देखते हैं. It's like it's a very common way of approaching this problem, right? So the way we think about this is whether if I get a 15% good consistent ROE at a, let's say 1 price to book or 1.5 price to book, versus if I get a 20% ROE at a 7 price to book or 10 price to book. I mean, I'm saying price to book, you can convert it into price to earnings. Is that better or that better? Now, since there is a correlation between growth, profitability, dividend payouts, and valuation, your filtration criteria has to give weightage to this. Okay. And that is why we don't tend to have screens which are absolute screens, which run across the entire universe. We have screens which are defined at an industry level, okay, and at a type of company level. So for company which exhibits a lot of cyclicality, I'm not saying cyclical stocks, right? Because the moment I say cyclical stocks, you start thinking steel, sugar, cement, all that kind of stuff. I'm saying businesses that exhibit cyclicality versus business that exhibits structurality needs to be evaluated differently. And that's how we start. So the ideas come from there. Okay. Then of course we have the first step is go back. A large amount of studying of the history. I mean, research process, I don't know whether I need to go into the depth of research process, but it's pretty much similar to every other value investing. The principles remain same. You're asking the same questions. When you start at the revenue level and the growth level, you go back and you ask what has led to this, growth, whether it is volume, whether it is market share, whether it is pricing, etc., etc. And those, but I don't try to get that insight from somebody's words. I try to get that insight from the data itself. That is where the difference between evidence-centric investing versus something else lies. Why do we do that? Because eventually I've learned is that many times what you hear and what you see in the numbers, they don't just match. Now, if I ask you a very simple thing, yaar, teko ye dikh raha hai. Let's say, I'll give you an example. The difficulty is I don't know where SEBI will draw the line, what kind of example is good or not. But let's say any company you can pick up, let's say GAIL, right? Gujarat Ambuja Exports. If I ask you whether it's a cyclical company or a structural company or whatever you want to call it, is there a way you can do that? Is there a way you can define that? Now, there are many people who say कि यार maize है, तो commodity हो गया, right? Commodity business है, etc., etc. The answer to that question should not be coming from there. Of course, there is a common sense, but the answer to that question should come from looking at the margin profile of the company, looking at the cost profile of the company. When you look at the gross margin level profile of the company, you will get an idea whether this company is actually cyclical in nature or not. Because cyclical companies, or the companies which demonstrate cyclicality, has certain nature, business characteristics, and those business characteristics will reflect in the numbers somewhere. Okay, and another point which I want to add here is, let's for a minute assume that Warren Buffett comes and say, "Yaar, nahi ye company cyclically hai." I mean, just assume that the biggest authority comes and says ki this is cyclical or this is structural. Okay, whether you are going to believe that word, even if the data is saying otherwise. Okay, so let's imagine that somebody says this is a cyclical company and you are seeing amazing consistent margins across cycles for that company. Are you going to believe this EBITDA margin, or are you going to believe that statement? Okay, obviously you're going to believe the numbers you're seeing, with a caveat, by the way, with a caveat that the numbers are correct. Okay, so वहाँ पे वो forensic वाला and quality of earnings वाला element आ जाता है कि आप numbers पे trust तब करो जब आपको पता हो कि number सही है. Okay, so that anyway, keeping that aside, assume that is correct. If the number tells you that this is a structural business, no matter who comes and say this is a cyclical, I won't trust that guy. Okay, even if a promoter comes and say कि नहीं यार हमको नहीं बनता है because यहाँ दिख रहा है, right? And that is where, I mean, I'm taking the examples so too far just to make a point. Obviously, Obviously, promoters know about the businesses, and smart investors are not going to make these stupid statements. But I'm saying that when you stop falling for words and you start looking for actual facts, that separates the truth from fiction. Okay. So this is where the first step is. We do lot of back study. Okay. We don't do 5 years. We don't do 10 years. I personally have a model that captures 20-year cycle. All companies, no matter, obviously jiska nahi hai, nahi hai. But my model captures 20 years data, and it's fully detailed, and we study each and every line item to see how things have moved. Of course, that some people will say our industry has changed a lot in 20 years. Sure. I'm not going to give weightage to those things, but I need to understand how it evolved. And that is where the going back helps, right? So this is how we study about the companies. Eventually, why are we doing this? We're doing this to take a call, like everybody else, is that whether something is dramatically different happening right now. And if I can believe the past numbers, and if nothing is changing, okay, can I take a view on this company from a valuation perspective? And that's how we go about companies. So we do evaluate businesses. We do look at businesses in the long term. Everything which the value investing community says, the methodology is same. The points are same. It's just that the questions, the source of answers is more centric in facts and data points and numbers, etc. And we try less to give focus on the words which come from people. So that's the process we follow. And eventually it's the same thing, right? So you value a company, you be as conservative as possible. Now, conservatism doesn't come from reducing the number in the forecast. Okay, conservatism comes from knowing that what say something is 20% growth in last 3 years. Okay, I've seen the tendency of people to say 3 years very recent growth is a good substitute for the future growth. Okay, now this is where the most of the goof up starts to happen. When you try to project things in, what you need to understand is what is the source of the 20% and whether the source is remaining consistent or not. And even then, we always are on the side of conservatism, right? So I'm famous for telling people a word which is yaar, ye to bahut overvalued hai. This is a consistent line. Most of the people, when they ask me about a company, my first thing is ki dekhi to hai, but bahut overvalued hai, right? So generally, I'm very conservative on the valuations front, and there's a belief system which has come from doing a lot of work and knowing that valuations. Okay, by the way, when I say low valuation, I'm not saying absolute low valuation. That is very, very important to understand. I'm not saying 40 PE is high and 20 PE is low. I'm saying 40 PE for a 15% ROE company is high, and and 20 PE for a, let's say, I'm just giving a random example. I'm saying context of fundamental along with valuation is extremely important, which people that is where majority of the value factor people make a mistake. When they say, go back to, all the books which you have read or all the papers you've read, they say low PB investing. They don't say low PB in context of fundamentals. They low PE investing. So even the Tweedy Brown paper, What Works in Investing, a very popular paper. I don't know whether you read it or not. It talks about these themes which have worked. And there's a fabulous book by Shaughnessy, which is what worked on Wall Street. All those things are somewhere they get this part. It's not that they ignore it, but it's just that it's missed. They say low PE investing is value investing. Low PB investing is value investing. Of course not. Low PE investing is not value investing. Low PE for a decently fundamental company with decent growth profile is value investing. So you can't ignore the fundamental of the companies to the valuation exercise. But anyways, that's the process we follow. There's a lot of work that goes into formulation at a portfolio level. So ये तो क्या stock picking, but then where does the stock go, how much allocation, etc., etc. But everything now comes from a well-tested framework as to why we are doing what we are doing. Okay, and everything comes with the testing of it. One exercise which we do very rigorously is, if we believe after studying the company that this kind of a environment is a good environment for this company. Okay, just say a lot of people say, again, let me take an example of cyclical companies, right? So they say when heavy capex starts to happen, when when almost everybody is doing capex, when the valuations are above 1.5, whatever the number people fancies, that's usually means the end of the market is end of the cycle is coming, and the reverse, right? When they say that there's a large amount of consolidation happening, low capacity utilizations, etc., etc. No matter what you studied, there's a belief system about a particular environment for a company that you say, okay, this environment is good for the company, this environment is bad for the company, or this valuation is good for the company, bad for the company. We do a lot of testing on this part. We go back and check whether what we have studied and understood, if we have practiced, if we do practice it, and we would have practiced this in past, whether it would have worked or not worked. If the answer to that question comes no, okay, even if I'm very confident on my study, I still don't go ahead with pressing the button. So that's the process we follow. I mean,
Thanks.
yeah.
So you touched upon valuation, and I have a question on valuation also. But before that, I think we have covered a fair bit on the backtest, on the evidence, on your investing style and research process. I would now request you to shift towards your library of mistakes. And I know there is a big presentation which you gave to CFA Society, but I'll ask you to basically categorize into two types of mistakes. Mistakes which you did in the past and not doing now, and mistakes which are so difficult that you continue to do even today, but probably you are cutting down on those mistakes as and when you evolve, but it is very difficult to get over those mistakes. So just these two buckets, if you can frame, I think that would be very helpful.
Trap question bolte hain isko, trap. The second part is a trap question. Yeah, so again, you know, I mean, whether it is a backtest topic or the library of mistakes conversation, they eventually became those presentations only because there was just way too much to talk about that, right? So again, library of mistakes, the first thing when I started with the presentation, I said is to assume that all these mistakes are mine. And it probably won't be too wrong. Probably most of them would be mine, right? So, and if I'm not wrong, I'll just see what I did. That was long back. I did this presentation.
You want me to share the presentation?
No, it's okay. It's okay. I remember keep classifying, since you asked me, you know, categorizing the mistakes. You know, if we can open, it's great because
I have it in front of me.
That will be good.
Just give me a second.
Yeah, sure.
Yeah, I got it. I hope you can see it now.
Yeah, I can see.
Yeah, great.
Just go to one of the pages would have all the mistakes classified. Yeah, this one. Yeah. So this is how I classified the. This is by the way, this is not an exhaustive list. Okay, this is something which I found requires discussion. Okay. I would probably start with the reverse answer. Okay, which is what mistakes I used to do and probably have stopped doing, or at least have curbed doing a lot of them. I would say that lacking discipline wala thing. Okay. Now I don't lack discipline in my research, but as I told you, where I lacked discipline was to make notes about everything, every decision which I'm making. And eventually I've learned is that discipline is even more critical than the discipline you follow for your research. My process has always been touchwood. I mean, it's a good process. At least I think so. Obviously people can differ, but that was never my issue area. My issue area was, so the lacking discipline, probably I would have covered that point. I don't remember what is there in that lacking discipline thing. I'm sorry. So one is what mistakes I currently do and find difficult. What was the first part of the question? Sorry, I forgot that.
So I was saying there will be two types of mistakes. One mistake was which you did earlier also, and you find it very difficult to get over it even today. And the other one is where this mistake, this category of mistakes you used to do in the past, but you don't know anymore. Because you have evolved as an investor and you don't do it anymore.
Yeah, I would probably, I would probably love to think that majority of these mistakes I don't do anymore. That is why I made a presentation out of it, right? Saying that these were all the mistakes I used to do. But yeah, see, omission mistakes you can't avoid. Okay, by default, that's a part and parcel of investing. Mistakes is to understand why it is a mistake. So, that is where sometimes you still fall for. One thing which I feel is a mistake, but I still fall for it, is over concentration in my personal portfolios. Okay, when I get way too convinced with something, even though I know that I should not be going all over all the board, you might not call it a mistake. Somebody might think this is conviction. Okay, but all what I have learned is that nobody should, at least I should not have that much conviction in anything, because the investing world is like that. It's too volatile to have very high convictions in things. So sometimes I go overboard with allocations in the personal portfolios. I have strict rules when it comes to advising on the client portfolios, but I lose that discipline in my personal portfolio. So I have gone 70-80% in one single stock when I'm very convinced with it.
70% and
80% also.
okay.
So yeah, so I'm saying over concentrated means that I'm anyways over concentrated in the personal portfolios. I don't buy a lot of stocks there. But having said that, I think I should curb that. That is something which I have been, but sometimes my enthusiasm and my confidence takes over, and I take more. And I'm not saying mistake because it has made me lose money. On the contrary, when I took 80% bet at the bottom of COVID, that's the maximum money I've made in a smallest period of time, because the stock did extremely well. Everything we did well. This did even extremely well with a absolute low risk business. Okay, so probably a 3x kind of a thing in a matter of few months or so. So but it's still a mistake because it's not a great investing style or a principle. I could have easily lost if it was not COVID, and if it was like 2009 kind of a drudging market, I would have probably lost crazy amount of money, even though the business was good. And this reminds me of Gaurav's story, right? You mentioned Gaurav. Gaurav talked about Ashana and 90% losing. It's that kind of a journey, right? So this is, I know it is not something I should be doing, but sometimes I do it in my personal capacity. Something which I have stopped falling for, the list is there in front of you. People can probably go and listen to it. But one thing which I have stopped doing is, or one thing which I drastically, as I've told earlier also, I have stopped doing things for the sake of doing. It seems like a commonsensical thing to do, but I still see a lot of experienced or inexperienced people. They do a lot of things because somehow it just makes them feel comfortable. It's not adding value. Okay, or because somebody has said that they should do it, or whatever. Everybody tries to justify their existence in the world, right? So sometimes we do things for the sake of doing things rather than actually having. I think I've cut down a lot on that. And I've given you an example, right? I've stopped meeting management because it doesn't add any value to me. I've stopped on the ground checks from inside generation perspective. I do it for different reasons, and that has reduced the activity to maybe 20% of what I used to do. So those kind of things I've stopped doing. I've stopped looking for narratives. I don't want fancy narratives to buy or sell companies. Okay, that's another presentation which I did for, I think, Delhi Investors Association or somebody, was narrative and data spectrum. Okay, and that was evolution from how narratives to data the things goes. Yeah, there are many more. Another mistake I can probably say is on valuation front, which I have stopped doing now. Since you said there is a question of valuation, I'll probably cover it later. What else? That's such a difficult question to answer. There's so many mistakes.
Great. So as I said, I have a question on valuation. So I'll come to that.
Yeah.
Right. So we have spoken a lot about backtest, mistakes, your investing style, but we have not discussed an important piece of the puzzle, which is valuation, right? So I'll again go back to an old tweet of yours where you mentioned that decadal multi-baggers
Yeah.
always, in fact, you used the word always twice in that tweet,
Okay.
always start with moderate to low valuation and medium to small size. Please
Yeah.
expand on this. I can probably repeat it for the benefit of all the audience. So Puneet tweeted this: decadal multi-baggers always start with moderate to low valuation and medium to small size. And I would now like Puneet to expand on this. I'll again try to influence you by saying that if you can put in some case studies, that would be great. Yeah.
So this particular, I mean, there's, I think I can take one case study, but see, again, this particular tweet is a perfect example of that evidence lab structure, right? We started with a question about multi-baggers and decadal multi-baggers, and this came from somewhere. Some genesis must have been there. I must have talked about it with some fund manager, or some friend would have discussed this. And decadal multi-baggers, when people are talking about how this stock became 10x and 15x, and stories are good, but what if you really want to find what are the commonalities between this exercise? 10x version was the Goa presentation in terms of the scope of the activity. But anyways, but the genesis from this thing was that, okay, let's look at the decadal multi-baggers and see what do they have in common. And the decadal multi-baggers basically was, we looked at yearly 10-year winners, and we arranged them in descending orders, and we found out, okay, what were the starting points of those companies. Okay, so we divided, and I think we worked with, if I'm not wrong, top 10% or something like that. I might be wrong here. I don't remember exactly the details. It was long back. And this came from there, that if you look at, I think somebody mentioned Titan in that, which didn't start with a low valuation. I slightly disagree with that statement, but yeah, I still buy that statement that maybe pertaining to it fundamental, which was there at that point in time, it was slightly overvalued, sure. But barring that, every other company.
I was that person who responded to that tweet.
Yeah, okay, so I'll discuss it in detail why I don't agree with that line entirely. But I do understand where you're coming from. Why would you call that as an expensive stock? Because yeah, on all parameters you valuation measurements, it would seem like an expensive stock, right? But anyways, but barring that, almost every stock which was there had these two things in common. Okay, it was medium to low size, and you can probably take a size limit of around 5,000 crores, less than 5,000 crores, obviously. And almost all of them were trading relatively cheap or in the payable range of valuation. Now, the moment I say this, I am saying a very subjective statement, because people think valuation is subjective, but if you have to test something, you have to convert it into objectivity, right? So when you convert it into objectivity, and you can't say, okay, greater than 20 is high valuation, 10 to 20 is okay valuation, sorry, something like that, and less than 10, something like that. You can't do that, right? You have to take into consideration the fundamentals at that point in time, and so on and so forth. So that exercise we did, and when we figured it out, कि सबका होना कितना चाहिए, a broad range, reasonable range, और कितना था, and almost every was. So the way we do our investing, so the valuation numbers, we divided into 3 buckets. Okay, this is a no-go valuation, a payable valuation, and an exciting valuation. Okay, and majority of them were in the exciting or payable zone. Okay, majority of them were actually in the exciting zone. Very few were in the payable zone. Titan probably was in the payable zone, so I'll come to that later. But that's how it started, and then eventually we have seen that in our portfolios, right? I mean, some of the I don't have a decadal multi-bagger, okay, but I have like a 40-45% compounders in 6-7 years kind of compounders. So those names have the same traits. They started with very reasonable, very cheap valuations. Businesses were strong. It's not that they were cheap but also understand that you have to also understand कि ये जो learning है, ये आगे use हो सकती है कि नहीं. So for all the listeners, what will it take? कि यार ऐसा company ढूंढो. I'll also say one thing, that we have dramatically different market setup now versus what was when we had those multiple decadal multi-baggers, right? We have much more information, knowledge, and the kind of cheapness in good quality names we used to have in the markets, we probably don't have anymore. The value, what do you say, the time for a company, for a market to actually see value in it and then reduce that value price gap has reduced dramatically. Earlier, you used to get years before that happened. That reduced to months. That is probably reduced to weeks now. Okay, so so that's an important point to take also. So let's not always say, "Acha, theek hai, now I'm going to look only in this space and this space," because probably you're not going to have similar cheapness in the valuations in the great multi-baggers for the next decade. Maybe not. I don't know. Okay, but that's how it started, and that's eventually the whole idea of that tweet was. And I mean, so examples from my portfolios where we have held, I mean, I've personally held, or the fund we used to manage held. Relaxo was one of our biggest wealth creator. When it started its journey, it was not bad on fundamentals at all. It was a very cheap stock. It was much lower in market cap than Bata was, much lower. I think 1/10 or something. I don't remember exactly. It had all the traits of a good stock available at a good valuation, and it turned out to be one of the best holdings. Another place where if I would have given a heed to a lot of market chatter I was listening to from smart people, I would have probably sold that stock. Okay, and when I focused more on the facts and the numbers, that I mean, I don't know whether you remember this, but Relaxo has this case with Bata for Sparks brand. I don't know whether you know this, but there was a huge hue and cry about this particular case, and Sparks used to be a large chunk of their revenues. And I talked to many smart investors. I'm not saying they were wrong in their assessment. It's just that everybody was predicting that this will not happen. Um, the Sparks brand will not sustain for Relaxo, and eventually Relaxo ka jo brand hai, this will get diluted and it will probably go away. And credit to the team I was working with, a lot of good smart insights came from there. And one was that if the business owner, and at that point in time, Mr. Dua, who was running the company, was focusing a large amount of his money was going into developing that brand. And if you remember, there was Katrina Kaif, I think, I could be wrong here, but maybe Katrina Kaif, Akshay Kumar, all these were coming as brand ambassadors for Sparks brand. And he was putting the money to build this brand. Now, just commonsensical thinking would probably say, yeah, why would you spend money where you probably know you're going to lose, right? So a lot of conflicting points came, and till the point the numbers kept on showing, we didn't sell. Okay, and we just kept on. So that's another learning from why don't fall for narratives. Keep on looking at when the story is there, and it worked like a charm. Similar story with VST Industries. Started at a very cheap valuation, phenomenal business. Currently, I'm talking long back. Okay, so don't compare current VST with that VST. APL Apollo, another stock we used to have, and so these are the kind of journeys, and all of them share the same characteristics. The tricky part is not knowing these characteristics. The tricky part is to actually hold something for a decade. Okay, it's very easy to do a study for decadal multi-baggers, but it is actually extremely difficult to actually hold a decadal multi-bagger. Okay, that's the more tricky part on that. But yeah, that's a debate or a discussion for later.
Great. So I'll move on to the next question after the valuation. So this is probably, I don't know how tricky or how easy it is for you, but this is one of my favorite questions, which I try to ask to all my guests.
Sure.
Is that assume you have all the learnings of the market and you have no possessions or clients with you. If you start your investing career again today with only 5 lakh rupees and your years of learnings, how would you go about it? How will you put that into work?
Well, that's a question I don't want to answer without thinking. How would you go about it? I would Okay, it's a very difficult question to answer. I'm honestly, I'm stumped with the question. But let me think. So I have no possessions, no clients, and I have just 5 lakh rupees, and I want to invest that, right? That's what
But
you're
you have
asking.
all the learnings. Huh? It's not that you are new to the market. You
Yeah.
have
So
your 20 years of learning, whatever you have spent in the market.
yeah. So my biggest learning is what the whole center of this presentation is. Okay, that don't focus on the narratives that float around in the market. Okay, unless you have a solid reason to believe something, and it can be evidenced, tested. Now, understand one thing. I always say evidence and not data, because there's a huge confusion in mind of people when the moment we say backtest, somehow people think that we are some like a huge quant arm sitting only doing data crunching, number crunching. That's not the case. The evidence is not just data, it is facts. There's a difference between just data and facts. We do both, of course, but facts are also important. But anyways, so that is one, without a doubt, that is my first key learning, as well as the message to myself if I'm doing that all over again. Okay, because in the earlier part of my career, and especially as a part of the fund, which was, as I told you, there was a macro call and working at the micro level, I had this huge fascination of becoming a macro investor. And I can't probably tell you how many books I would have probably read on macro investing, and studied all economies, right? I would have studied China, Japan, US, their entire cycles, because I was trying to learn how to pick stocks from a macro angle. Okay, and not only stocks, commodities, because I remember I used to read everything Jim Rogers at one point in time. Everything. I think he has written a couple of books, whatever. So everything there. Okay, so a lot of macro driven thinking I used to do. Eventually, I'm still to find somebody who actually can do good investing based only on macros. I'm not saying there's not people who cannot come with insights, but at least personal level, I don't know many who can use great macro understanding to create ideas for buying this. Very few might be there. I'm not saying they don't exist in the world. Of course, you can say Soros was a great macro guy. Sure, he was. I'm not saying I'm not comparable to anybody like that. I'm just saying I personally don't know. Maybe my circle is too small. So my learning to myself is don't waste that time. Okay, I'll coming back to your answer. So keeping 20-year learning, I will not waste any more time doing that. That again, the important part here is macro is very important for the context building, and also to know if it's a part of your thesis already. But it is not the place to start for finding ideas, at least not for me. So to myself, I will go back and say, "Yaar, mat time waste kar. Isme mat time waste kar." Okay, so that would be another thing. And another very important learning which I'll keep with myself is my forensics learning, which I painstakingly developed during my initial years of investing. When I say initially, I'm talking about the fund. When I was working for the fund, remember I was a CFA charter, I was an MBA finance, but I was still an engineer. Okay, so no matter how much you have studied, accounting is always a Achilles heel for engineers turned investors. So I joke with a CA friend of mine. I joke with Nitin also. I think he's on the call. I joke with him also ki I have probably done half CA by reading accountant books and annual accounting standards, etc. during my journey when I was learning about, when I was reading annual reports, because it just made intuitive sense कि अगर आपको accounting के rules नहीं पता है तो उसमें जो लिखा है उसका आप क्या sense बनाओगे. That's why I spent a lot of time doing that. I would, and forensics, another thing which I would probably keep with me. Don't invest if you're concentrated. And by the way, if you just 5 lakh rupees, I would suggest you become a bit more concentrated for yourself. If you do concentrated and you fall for bad names, you might think कि पैसा नुकसान नहीं होएगा. But no matter how much journey you do, you probably will end up losing a large chunk of money, no matter how big the name is. I don't want to name the recent case, but it was not a surprise, right? So luckily, and I don't take a lot of pride in it, because pride is a very sinful word. But one thing which makes me feel very happy is that over all these years, all the names which you hear, which have come out in light, इसमें fraud निकला, ठीक है? Luckily, because of our processes, we were able to avoid all those names, which I feel happy about. Doesn't matter. मतलब ऐसा नहीं है कि that makes कि everything else was just mind blowing. What I'm trying to tell you is that those names, when they actually fall, you probably get no exit. Okay, in small cases, you can get out of the stock also. But if you carry the same learning at a larger level and you're managing large chunk of capital, that becomes a big mistake to do. So that is one learning I'll take. Yeah, I
Great.
probably
So
don't have more answers there.
I think what you mentioned towards the end of your answer reminds me of that topic, which I think I learned first from Professor Bakshi's blog. He actually starts all his classes with that, where your aim is to not only reduce error, but also to increase insight. So what you mentioned about is reducing error.
Yeah,
Right.
I used the same framework when I started the library of mistakes. So I obviously took it from Professor Bakshi's class only.
Yeah.
He recommended this book to us by Gary Klein. Okay.
Yes.
So that is where that framework came from. And then I also use the same frameworks in my conversation. And yes, I completely agree with you. So
Right.
I see, it doesn't matter when you're small, these mistakes are not going to hurt you a lot.
Mhm.
Okay, but if you are responsibly, professionally managing money for other people, this is one absolute no-no. Absolute no-no. Okay, that is why I check every other idea with Nitin bhai. I call him and say, "Yaar, ये मेरे हिसाब से तो ये लग रहा है, आप बताओ." But anyways, yeah.
Great. So coming to the closing point of the session, so
Yeah.
some really simple questions and light questions, I would say. So in his tweet yesterday, Mr. Devasis Basu of Money Life, he wrote the importance of reading books and how he hardly finds any new intern or anyone who is coming for an interview. So he said that he mentioned there that in the past, when people used to come for interview, they used to tell that they've read this book, they've read this book, and they've learned this from. I hardly see anything like that today in today's generation. I, in fact, responded to that tweet and I said that in case of today's generation, the right question would be which YouTube channel or which podcast do you listen to, right? So I would ask the same question. So any book, YouTube or podcast recommendation you would like to make for the audience?
Okay, so I'm not much on the podcast, even though sounds crazy because I run a podcast, but I'm not much on the podcast side myself. So the only podcast I can recommend is mine, but because I don't have a lot to recommend. But anyways, on a serious level, see, there is a difference between consuming podcast or a YouTube channel versus a book reading. Book reading is a active engagement, whereas YouTube or a podcast is a passive engagement. So you passively consume information. There's a lot of consumption. There is very little processing. Okay. In fact, while reading book, you are consuming, but you're parallelly processing also, and especially because reading is slow by default. I mean, that's the nature of the activity. Okay. So when you're reading, you're also thinking, you can't avoid it. You can't speed read through a investing book. Okay. So and once you're reading, while reading, you also bring your experiences together in the context of what is being said. So वो internalize हो जाता है. Either internalize हो जाता है या conflict create करता है. But वो तभी करता है जब आप सोचते हो, right? तो आप सोच ही तब पाते हो. You are able to think only when you are actively engaged in something. So that is where I think book reading has no substitute in the YouTubes, on the podcasts of the world. Where they are absolutely brilliant is a variety of consumption in a small matter of time. Okay, so you can probably listen to a investing podcast and go through an idea from a new idea, which probably you wouldn't have thought about it, and reading it from books might have taken a lot of time. So you are exposed to a lot of ideas. Now it's debatable whether it's a good thing or a bad thing. Okay, too much ideas also is not a great thing, but that's the advantage of it. The flip side of it is that you're just passively engaging, and that is why whatever thing I read, I listen to nowadays, I do it actively. In fact, very recently only I was in Mumbai, I was talking to somebody and he said, a podcast sunna hai. Right? So I was listening to it, but nowadays I don't listen. Earlier I used to listen while I'm driving the car, while I'm walking, that was my podcast consumption time. That's how I used to think about it. Yeah, podcast consumption is equivalent to why waste time when you're walking, why not listen to a podcast, right? Now my podcast consumption is also an active conversation, which is I sit in front of the system, I keep on making my notes, I keep on pausing the podcast, think about it, and then make my notes and so on and so forth. So it's an active engagement. And that's how it helps. So, and as far as books are concerned, I would say don't overthink or overcomplicate on books. There are just way too many good books to tell which one to read, right? So my answer to that question will always depend on ki kya chahiye aapko, what are you trying to learn? If you're a novice and you're trying to learn a way to think about markets, Benjamin Graham, Intelligent Investor, everybody says here, I mean, it's not something which is a new news, right? Everybody says Intelligent Investor is a good book for getting the initial thinking about money, right? Rich Dad Poor Dad is very popular amongst the guys who are just starting out, want to have a thinking process about money. Technical book, I would say it's very surprising that majority of value investors I meet have not read security analysis. It's very odd, but that is true. Okay, but that's a fabulous book. It's just a mind-blowingly good book, and no matter when you read it, even in the world today where you think Graham probably was way too outdated, the principles and the way of thinking that comes from security analysis is just mind-blowing. So that's a very good technical book to read. I mean, there are many. I have to instantly think of. In Indian context, Parag Bhai wrote a book, Parag sir, Value Investing. That was a very good book. It's called, I think, Value Investing and Behavioral Finance, if I'm not wrong. That book is good to read in Indian context. I do like to read interview-centric books also. So The Market Wizards is a fantastic book to read, set of books to read. In Indian context, Masterclass with Super Investors is a good book to read. So there are all these are great books. Capital Returns is a great book to read. There's no dearth of good books. I mean, I can go on and on about good books, but largely the answer to that question will depend on कि आपको उस समय क्या सीखने का मन है. If the answer is okay, मेरे को investing के बारे में general information सीखनी है, then there's a different answer to that. Specifically, there's a different answer to that, and so on and so forth. But no books over podcasts or videos any day. I understand the appeal for the other two, but there's no substitute for reading. I agree with Debashish. Maybe I'm old school in that way, but I agree with Debashish on that front.
I am also pretty much old school in that way, and I think I really like the way you explained about the passive and the active part, because I also belong to the same school where I read from physical books. And even in case of podcast, what I do, and why I want to share about it right now, because if I like a podcast, I try to get hold of its transcript. I take a printout of the transcript and I make notes in that transcript printout. That is when, and I keep, so this is not my table right now. If I would have been on my table, I would have shown you some of the transcripts which I have taken a printout, because then only you actually get to the depth of it. So probably
it's the same here. Here. I take the printout first. I take the transcript first.
Exactly.
No, I don't take printout, by the way. I do everything digitally, unfortunately. It's too difficult for me to manage. Sometimes when I'm not in the mood to read digitally, I take physical printouts, but I'm mostly digital now. So, but yeah, transcript is first. Nowadays, fortunately for us, ChatGPT's Whisper is brilliant in terms of getting transcript from audios, even if it's an Indian author.
Right.
So that's a good. I mean, Otter is good if you want to use it for transcript. So we do that same process. Transcript is very important, and that audio and notes are the three combinations I generally take when I'm listening to YouTube.
Great. So thank you so much, Puneet. I think it was really interesting for me, and also from audience perspective. I'm sure people who joined and listened to you would have benefited a lot, and I'm sure many will watch the recording also when we'll put it up on our YouTube channel. Before we leave, any closing thought or anything you want to leave us with? That would be great.
No, I'll take questions. I mean, say, okay, one thing which I tell people is that take anything with a pinch of salt when it comes in the investing world. Okay, because everybody, when he's saying something is with some, I'm not saying people lie. On the contrary, I think people are very honest in the investing world. It might sound surprising, but I really feel a lot of honest people tend to give a lot of things in their honesty to other people. But everybody has their own experiences and their own environment in which they have learned the investing world. Okay, so don't take anybody's truth to be your truth. If I have to leave with that one probable statement is that. So कहते हैं वो सुनो सबकी करो अपनी, it's like that only, but वो करो अपनी के लिए आपको काम करना पड़ेगा. How would you know कि किस चीज को करना है और किस चीज को ignore करना है? Right, so that is where I think majority of investing learning effort should be, and that would be my only recommendation. Not much to recommend otherwise. I'm open to questions if somebody have.
Yeah, thank you so much, Puneet. If anyone has any question, yeah, so Harshal asked this question. Any advice for someone who is starting fresh, who has no knowledge about the market, probably is a beginner, he just joined the market now, or maybe in the last 1 year or 2 years. Anything specific you would want to say?
Okay, starting afresh meaning you're okay. Let's assume that you are a fresher in the sense of age and wisdom also and investing, because many people who start late, they have actually an edge which they don't realize, right? So with age and wisdom, they still and have some constructs about human psychology which become very helpful in the markets. But let's assume you don't have that, right? Okay, in that case, I would say one thing which I would definitely recommend is that the first thing people say, read a lot about investing. Okay, I generally tell people that, you know, you will have all your life about reading about companies and investing and everything else. First, build your knowledge base in a way that you can appreciate and dissect what you are going to read. So if you don't have a base for that, okay, then you can read the best brokerage house reports, sell-side reports, or the best books in the world, or listen to the best people in the world. Since you will not have the knowledge base to dissect, you know, separate the wheat from the chaff, so to speak, there will be no, what do you say, a grounding pole which you can make the center of your thought process. And that is, so people who start by giving investing books to freshers, I think do a big disservice to them. Okay, so I think that is where the first start is. And when I say fundamentals, I'm actually talking core things which are required. For example, if your aim is to become a fundamental investor, you shouldn't do it without understanding accounting to some level. Okay, it's a must learn. There are fundamental investors who talk about businesses, they don't even know how to read financial statements. It's very funny, surprising. Twitter is full of them. I don't want to name few of them, but it's clear that they don't know how to read the financial statements. So that is one. Go to the absolute bare minimum thing. Second thing is, and this might be very reverse from what many smart and big investors have said, learn the tools that are helpful to do analysis. Again, people spend a lot of time in understanding क्या ratio analysis करना है, या क्या मेरे को ये करना है, क्या मेरे को करना है, but tools नहीं आते होते, right? So spend time on learning the tools. And nowadays we live in a world where the tools are very powerful. Okay, spend some time on, I don't know, a tool of your choice. It could be Excel, it could be anything, but you will need number crunchings to be done. Make yourself aware of these tools and then jump into the pool. Okay, so then jump into the pool, because now when you know the tools and you know at least the underlying philosophies, you can at least question, and whatever you're reading, you'll ask a question. At least you will be at a place where you will be able to ask a reasonable question, which otherwise you will never be. You will become a passive consumer if you just start reading about investing books. And this I learned the hard way, right? I told you first thing which I read was what? Warren Buffett 1977 letter given to me by Professor Bakshi. He gave me that letter and I read that. And the first line talked about return on equity as a great way to judge the business. And in the bracket, it says without undue leverage or something like that. I don't remember the exact words. I'm paraphrasing, right? So, and I'm reading that, and I'm an engineer who don't know what return on equity means, right? I have no idea what he's saying, but because he's saying, and Professor Bakshi asked me to read it, obviously this must be truth, right? So you become a consumer. You don't become an engager with that content. And that will be my only advice to somebody starting fresh. Do the core basics first. Investing hoti rahegi. You have a lifetime to do investing and reading about companies, etc. Make yourself capable of asking good questions. I hope that is. I mean, I hope that is what you are looking for, and
Yes,
not
yes.
some investing book, because I don't have to get that.
No. I think Harshal has also answered. That was very relevant for him. Okay, great. So I think Nitin Bhai has mentioned one point. Why forecasting is not important, because change in dynamics may not be visible in past. So he's asking, you mentioned at the start that forecasting is very difficult, or you shouldn't be doing
I
it.
think Nitin Bhai maze le rahe हैं, but anyways. Okay, so remember I said forecasting is not important from the way we use forecasting to make it a tool for coming up with valuations, or to come up with models, etc. That is where I don't do any forward-looking exercise, so to speak. कि अच्छा next year का ये number होएगा, उसके next year का ये number होएगा, जो हम देखते हैं, right? Sell side में, or even at the buy side, a lot of people do कि अच्छा forward P कितना चल रहा है, forward PV कितना चल रहा है for next 1 year, 2 year. That thing I'm saying I don't do. Okay. Obviously, I also said one more line, which is you read the past to learn about the businesses. You rely on the past only when you are reasonably certain that the things are not changing. If the things are changing, of course, you will have to change with that. I mean, the past become irrelevant when the dynamics of the industry are changing. But we also should answer one more thing. Dynamics of industries don't change that frequently. They do change. I'm not denying that at all. But they don't change as frequently as we probably would want them to. Sometimes the dynamics, which we think as a dynamics change, is actually not a dynamics change, but a part of the cycle. Okay. And sometimes the dynamics do change. Okay. For example, real estate is a big example, right? People stopped being land grabbers and they started becoming asset light. Structural changes in the way real estate companies started doing their businesses. Okay. So they do change. Dynamics do change, but sometimes it's just a part of the cycle. So understanding, if you've done the past study, you should be, in my understanding, you should be able to reasonably comment whether the future, I'm not saying too far in the future, but whether you can reliably say that not dramatic changes are going to happen in this. Small changes here and there, new competitor coming, new products being introduced, technology changes, etc. It's part and parcel of every industry. So you can't ignore that.
Great. So I think one last question.
Yeah.
I think Harshal has asked this question again.
You'll have to give me just 1 minute. My battery is dying. Just give me 1 second.
Yeah, sure.
I'll just get a charger.
So thank you so much, everyone, for being patient. And I'm 100% sure that you must have enjoyed this session. And as always, we'll keep the recording and share the recording on the platform as early as tomorrow. And maybe by coming weekend, we'll put it also on our YouTube channel. Yeah, Puneet bhai. So next, the last question which we had, which is still unanswered, is on allocation. So again, as a fresher, Harshal is asking, anything you would say, for example, again, you can take the same question. He's having probably 5 lakh rupees. And he's asking you, how do I do allocation? And you made a very good point there that you should have a concentrated portfolio, because you can't put 5 lakh into 24 stocks or 25 stocks, right?
Yeah. Okay. So if it's coming from a fresher's perspective, I would say stop bothering about thinking about allocation, because we tend to think a lot about what all should be important. Okay, you have to understand a couple of things. One question is कि क्या मेरे पास ये 5 लाख रुपए है और मेरे को इसी को आगे बढ़ाना है, right? दूसरा क्वेश्चन है कि कहाँ तक बढ़ाना है, right? So the maths is very simple. You can probably have a target for yourself and do the reverse engineering and calculate the CAGR you require and think about whether that CAGR is achievable from what kind of allocation. That will be the first way of approaching this problem, right? Now, if the CAGR is exorbitantly high, which will be the case if you start from 5 lakh rupees and you think of having crores after a few years, the CAGR number requirement will be pretty high. It's fair commonsensical to say that even a concentrated, maybe you'll probably have to have very high XIRR trades. You'll have to do a lot of in and out, okay, which large amount of people they actually advise also. They do on small capital trading in in high XIRR and but number of trades is something. Now again, since I don't do it, I'm not suggesting it. I'm saying think how that XIRR can be achieved. Can it be achieved with one stock concentrated holding? Is it possible? Is it not possible? If it is not possible with that, is it achievable by doing trading and doing high XIRR trades? If you're doing that, do you know enough to even do that kind of trading? Which is a even more relevant question. Theoretically, you might be able to get that CAGR, but practically it's a very different ballgame, right? Trading is not easy. Okay, so I'm saying maths will say something, and that is where you will start. Uh, if that the question is changed from a experience perspective, I would say that I fully agree with a statement that is made usually कि asset allocation makes or breaks a portfolio. Okay, but I also and again something which we very funnily did, we took a lot of past portfolios of funds and we did this experiment. Something interesting came out. We actually are more confident of our high allocation stocks. Obviously, that's why we do high allocations with them. Generally, even though it is correct that high allocation in a best idea would obviously generate higher returns, but I've also observed that a lot of time your highest allocations are not your best ideas. They don't turn out to be a best ideas. You just think they are the best ideas. Okay, so very rarely they will coincide. I'm not saying that it will never coincide, but if you go through a large chunk of years and you go back and check all your large high conviction ideas, you will find that some of the low conviction ideas did much better than your high conviction idea. And in that way, if that is a consistency, somebody might not have that problem, but if that is a consistency, you should ask that question that whether being allocation specific is actually adding to your portfolio or not adding to your portfolio. Okay, we did in fact, in one of the CFA videos only backtest wale mein, we did a backtest on a quality portfolio, and we did multiple things. Okay, we did allocation based on market cap, we did allocation based on the parameter of the quality, etc., and so on and so forth. And if I'm not, and we also did a random allocation, okay, which is a very strong, it's a sort of strong construct to think. So think about this way. If I tell you that you go back and take only the stocks which you have selected, okay, forget about the allocation. And if I ask you, okay, now you just do random allocation to that. Now random ke parameters defined karke. So for example, in our case, we had a 25 stock portfolio. So instead of doing 4% each, we said we will randomly provide the weightage between 2 and 9. Okay, or 1 and 9, something like that. Okay, and we did that working. And randomized portfolio beat our portfolio hands, beat that other matrices portfolio hands down. And I think equal weighted did, if I'm not wrong, equal weighted random were pretty much similar. Okay, maybe equal weighted slightly lesser, slightly more. So what I'm trying to tell you here is, you might be saying I'm confusing you, but what I'm trying to tell you here is, don't overthink on something right now. And also be cognizant of the fact that not everybody who thinks they are high conviction on the ideas will work out the way they think their ideas. Sometimes the low conviction ideas actually do very well. So if you're starting, it's my humble opinion, I could be very wrong. It's my humble opinion is that stop wasting time on allocation. Go with equal weighted kind of a thing. Because in the starting, anyways, you will not have enough knowledge to bring that conviction which people think they should have to have high conviction ideas, right? So in the starting, don't worry too much about ki kisko kitna allocation dena hai. I would say even later, don't worry about it, but at least in the starting, don't worry about it too much. So go with equal allocation kind of portfolios, because you would probably not know which one will do well, probably. And I mean, no offense.
Thanks, Puneet. So, Puneet, one last question from Akhilesh. He mentions, do you recommend churning? I mean, when he says churning, I believe he's saying high churning of the portfolio when you have a small capital to achieve higher.
I'm not recommending it, okay, by any means. What I'm saying is do the maths and see whether that maths coincided with our kind of philosophy. If you give me because you put me on a hypothetical question of 5 lakhs and then I'm assuming anybody who's coming to investing has a multi-crore dreams. If you do a reverse CAGR calculation, you will come with a very high number, which probably will not be possible with on a consistent basis. You're not looking for 1 year CAGR. No? You're looking for a very high CAGR on a consistently long period. Okay. Achievable by concentrated investing. See, I know of diversified investors also who make decently high CAGRs. It's not that ki wo nahi banate. There are some good funds who do that. And there are concentrated guys who actually don't make that much CAGR also. So there is no what do you say, thumb rule around this. But the maths will give you a high CAGR number. And that high CAGR number need to be broken down into achievability. You will probably do a lot of churning of high XIRR trades because you probably want to pick 10, 20% very fast and then move on to the next 10, 20% very fast and so on and so forth. Whether doable, not doable, I'm sorry, I'm not recommending anything. Okay. So don't make me recommend something I don't do myself. Okay. So yeah.
Thank you so much, Puneet. It was great talking to you. And for me, the biggest takeaway was the active versus passive learning, which I feel many of us don't realize actually. In fact, even I used to do myself, but still I couldn't crystallize it in the way that the way you read a book and the way you process a podcast are completely different. So thank you so much, Puneet, for taking time out. And we had a lovely, lovely session today. And we'll share the recording as soon as it is up for all our community members and also for people outside the community as well. Thank you so much, Puneet. Thank you so much, everyone, for joining us. Have a nice weekend. Thank you.
I lost you. Okay. Yeah.
Yeah. Thank you. Thank you so much, everyone.
Yeah. Bye.
Bye.
Thank you for watching this session. I hope you liked this video. And in case you are also very irritated with this regular ads during the video, then I have a suggestion for you. You can become a member of Mission Smile community for free and watch all these sessions and much more premium content without any irritating ads. So the link is in the description box below. Do become a member. Thank you.